Tariffs, they're on, they're off, they're,
We're drawing on a very, very large canvas here.
It might not be a realistic long-term solution.
It's already starting to shake the freight markets.
Man, what a difficult decision to make when you don't really have any idea what will eventually happen. Okay, welcome everybody to another episode of Sparta Market Outlook. This is a special edition focusing very much on freight and essentially at the crossroads between freight and oil, I would say. So I'm here with June. June, hi, how are you?
Hi, I'm very good, thank you.
So we're obviously, as you can see, we're face to face. We're live in Singapore, and we're thrilled to have with us a special guest, Anoop Singh, who is the global head of research at Oil Brokerage on the freight side, correct?
Yeah, that's correct.
Fantastic. Well, Anoop, very nice to meet you, finally. I understand we've been speaking to each other in the past, but it's the first time that we meet, yeah?
Yeah, very, very happy to be here and very pleased to meet you in person as well, Felipe.
Fantastic. Look, I'm going to go off script directly from day one, from the first moment. It's interesting, when you think about commodity trading, shipping, etc. I'm always intrigued of how people actually get into the industry, because it's not one of those things that you go to university saying, I want to work for OB, VTOL, Trafi and all that. What's your story? How did you get into the industry?
I guess one of the accidents of life.
Uh-huh.
I used to sail on ships for almost 15 years.
Okay.
And then I came ashore, did a whole sorts of operational and commercial jobs before I moved into strategy.
Mm-hmm.
And then one of my previous bosses came to present to us, and I loved the work that he was doing. And I asked if I could join him. And so I've been now about 9 or 10 years focused on freight research.
Okay. And just recently, since at OB, since what, 2 years now?
2 years at OB.
2 years, no?
Yeah,
And you were
yeah.
telling that OB has gone from 5 brokers when you joined to now 58?
Yeah, 58. It's been a great growth journey.
Amazing,
for
yeah.
the company, and we've set up research starting from nothing on the ground, and we built a fairly decent research offering now over the last 2 years.
I think you're being modest there, but fairly decent. I would say it's very good. It's quite impressive. I have to say, it's the success story there is amazing, and I only hear great things. So glad to have you on the show. And look, a lot of exciting topics to discuss today. Everything shipping related, geopolitics, of course, with Trump, with what else do we have? Sanctions, tariffs, Trump refining new refineries, shutting down a refinery. So many things to discuss. I would say 3 main topics. I would say the first one being the main trends in the freight markets, and maybe let's start with that. And things that are disrupting the freight market, or any issues that are affecting the trade flows. Maybe we can start with the Red Sea. Anoop, what I've been hearing more and more is that the rumor is that we're slowly going to get into a situation where the Red Sea flow will open again instead of Cape. Is that what you're seeing, or what do you think about that?
I think we are a little bit away from there, from the floodgates opening. So at its peak, there were about 35 to 40 ships transiting the canal every week, and the straits and up through the canal. Over the last 3 weeks, that number has gone up from about 2 to 3 to about 8. And this is northbound traffic, which had been disrupted. I'm not talking about the southbound traffic, which has been insulated for multiple reasons. So we are still just about a tenth, or an eighth to a tenth of where the traffic was before things got disruptive. It's a little bit up in the air because politically things are still quite unsettled. And with over the weekend, we've seen the attacks on the Red Sea, on the Houthis rather, not the Red Sea. And so far, it's not reflected in price action, as in, we haven't seen freight rates respond, nor have we seen anything on the ARB side which suggests to us that there's an immediate response. But this is going to create a question mark in the minds of owners who might otherwise have been thinking that, yeah, let's follow the crowd, and start to put more ships into it.
Do the ship owners have an incentive, to, I mean, is it positive for them to go via Cape? Because I mean, I can think that there's going via Cape lengthens the shipping routes, so that's positive because there's less supply of vessels, but at the same time, you are doing less turnarounds of the vessel. What is the incentive for the owners?
Yeah, the owners tend to earn a little bit net additional freight, but it's not that much. So on an individual voyage basis, it's about $150,000 net, yeah, additional. So it's not a big number that way. Yes, it does tend to tighten the market because you've got many more ships deployed on both laden and sailing legs. But as an individual owner, you're always thinking about your ship and your fleet. You're not thinking really about the wider market.
Yeah.
Right. So as long as if your next business is being driven by what the charter wants from you, and if you are on the margins and saying, yeah, well, I'm all right, I'll do the trade because that's where the next business is,
Mm.
and the charter is willing to cover the additional the war risk premiums and so on and so forth, then that's how a decision would get made. It would not get made because a ship owner sitting there is thinking about where future supply demand balances might change because a larger fleet movement is happening through the canal or not.
Yeah, no, that makes sense, and that then brings me to what we were discussing with Michael Ryan, who, as we mentioned before, is our freight guru at here at Sparta, and we were discussing is that you would just need to have one of the big names that says, you know what, we are going to start. We feel safe enough, we have the insurance, we're going to do it, and then everyone else will follow.
That's interesting. The big names could be are probably the last ones to come in, because many of the big names, and I can't take names of specific owners, but many of them are listed in US or other stock markets.
Yeah.
So they are not even getting insurance quotes.
Mhm.
Right? If you're a US listed ship owner, no insurance is going to give you a quote to transit the Red Sea.
Yeah.
Yeah. So they're probably going to be the last ones to come in. Maybe private owners, some of the larger Greek names. But then when I think about it, most of the larger Greek names have already been providing the service.
Yes,
Right?
they've already been doing
Yeah.
that.
So in practice, there are going to be some frictions. That's what I can say. There are going to be some frictions because many of the large names and the product tanker sector, especially the ones which move diesel and all those things, they are very concentrated in the hands of a few public listed owners, right?
So, in practical terms, how does this affect the different vessel sizes? LR2s, LR1s, Suez. Who's benefiting from this right now, and if it does open, what are going to be the new dynamics in terms of price?
The segment which is at the most gaining the most of the LR2s. Right? So we did some numbers. On average, in 2024, after the Suez Canal sort of out of the Bab el-Mandeb crisis hit, about 10%, 11% demand growth for LR2s on a year-on-year basis.
Okay.
Yeah, and that's quite significant.
It is, yeah.
And that's after accounting for cannibalization by the Suezmaxes, which had cleaned up. Now the Suezmax cleaning up story surfaced again in January and February when the dirty markets were quite weak. But dirty markets are very, very strong again, right? And part of it is to do with the OFAC sanctions, which I think we'll address later on. So the dirty tankers, the Suezmaxes, are not trading in clean anymore, and therefore the benefit is going back to the clean tankers. The LR2s especially are the vehicle of choice, and so that segment is doing very well. Yeah. Yeah, go for it.
Yeah, no. So and June, before we move on to OFAC, because obviously that is the next topic of discussion. Any additional thoughts on what Sparta's view on the Red Sea and the next movements?
I think we are seeing for distillate where the question we always have is where are the Sika and the Jubal barrels pointing to? Last week, we interestingly saw it still pointing to the east for April loaders, even on the Suez route, accounting for the the working capital difference, etc. Because of a very strong east-west. So market sentiment wise is all still very price driven. not currently directly just influence on whether the Red Sea is open or not. Things might change this week. This morning I looked at the ups again, and now it's pointed back to the west because of the overnight issues with the Houthis, right? So yeah, it continues to evolve, this situation.
If I can sort of
sorry.
come in here,
Yeah.
I think before, perhaps just as a pointer to the addition, add on to that. So TC2 freight, TC5 freight, which kind of is more indicative for East-West hubs. We didn't see any weakness in that in the forward curve through Q2. So yes, I mean, but you know, the arbs might have started to point east, and if this was to translate, or if the sort of consensus expectation was that this would translate into a physical flow of the Middle Eastern barrel eastwards, then we would have seen it translate into a sell-off in TC5 paper, which is a very liquid freight rate, and we didn't see that, right? And we've seen that continue to rise. So which goes back to the point that at what point in time does a paper arb really start to affect physical flows? Yeah, and therefore, if it hasn't gone on long enough, the east to west shift, right, then it wouldn't impact either forward paper or physical freight. Physical freight remains very strong on the green side.
Okay, I was just reflecting on the TC5. I don't think it's only a distillate story, right?
For
it's
sure.
also
A
naphtha story,
Yeah,
which naphtha is, I believe the East is really pulling barrels right now, and the flow is very strong because of shortfall of naphtha from Russia due to
Correct, yeah.
one of the reasons, probably the drones.
Yeah.
So that is actually pulling up TC5, not just the distillate story.
Yeah, I guess it's a little bit of both. Yeah, it's a little bit of both. Certainly, naphtha story is to play for this.
Yeah, no, we were just before we started, we were discussing around the influence of paper on the physical market and vice versa. We obviously look at that mostly on the oil swap side.
Yeah.
If the arbs are open in advance, then you lock it in, and obviously by the time you actually get to physical movement, you can reflect that in the physical movement because you lock the arb in advance. I didn't think about it that much on the freight side, mostly because there's less liquidity on the TC products, but I don't know. I haven't really followed recently. There's been, I guess, a significant pickup on liquidity, on volume on the TC curves as well, or not?
TC5 is one of the more liquid ones, and that's sort of retained its liquidity level.
Okay.
On the route which has become more liquid, but that's not a recent story, is the Aframax route across the Atlantic, the TD25. After the WTI got priced into the Brent basket, so that's become a lot more liquid. Other than that, I guess there are more players who are interested, but we haven't. And gradually, every year liquidity does tend to go up, but there's no exponential change.
There hasn't been a massive step change. It's growing. Okay,
yeah.
fair enough. But coming back to now the sanctions, so we saw at the beginning of the year a new set of sanctions, which obviously had an impact on dirty freight, particularly on the Suezmaxes, VLCCs. And I remember having this discussion last year where, if you own a VLCC or Suezmax, you don't want, fair enough, there were better economics on moving them to clean. And you mentioned this before, at least last year. But having it in dirty operations is, holding a ticket or lottery ticket, that you never know there's going to be a sanction somewhere and then boom, massive spike on prices, which is more or less what happened at the beginning of the year. No, how do you see that evolution from now on? From here onwards?
The sanction, the OFAC sanctions, which came through in Jan, they took out about 80 odd Aframaxes from mainstream service, from Russian service. Out of them, about 80 to 90% are starting to slow down. Yeah, there are about 10 to 12 ships which are continuously still trading, but those are ships which are designed to load off a platform, and so they're kind of custom built for a trade, and they haven't slowed down as yet. But Russian exports, at least, have by and large remained intact, and that's because we've seen ships which would otherwise have been trading less time in Russian and more time outside Russian. They have started to increase their service within the Russian trade. And so the shadow fleet or the Russian dedicated fleet, we categorize it in four categories, out of which two categories are those which swing in and out of Russian business.
Mm-hmm.
Yeah, one of and it's two because one is mostly Russian, one is mostly non-Russian. Yeah, these categories. So the ships which were swinging into Russian for, let's say, half their time or more, or somewhere there, are now spending even more time in Russian business.
Okay.
So that's how that's how the problem, so to speak, has been solved on the Russian side, crude side. Yeah, but the OFAC sanctions are, uh, you know, uh, extend beyond just ships. Right, from the 12th of March, the banking waivers which were in place, General License 8, which permitted some of the Russian banks to clear US dollar transactions, that waiver is ending, right? So we're already hearing that many of the Chinese buyers are now hesitant to buy Russian barrels again. Yeah. So OFAC sanctions, we think, have a little bit more life left in them.
Mm.
Now, although the sanctions came on Aframaxes and Suez, on a few Suezmaxes, the big gainer were the VLCCs, and that strength, we think, is continuing to carry on. Yeah, and that was because of the price spread between sweet and sour crude, which certainly widened up quite a bit, but sour crude pricing up well above sweet crudes.
Yep.
Yeah.
And that has continued now even more with Venezuela not being also suffering sanctions.
Potentially coming from April, potentially that coming into play as well. So we think that spread, the sweet sour spread, so long as it remains wide, it continues to drive demand for Atlantic Basin crudes in Asia Pac. And I think NAFTA story probably ties in with that, because we think the Japanese and the Korean refiners and Taiwanese refiners would like that sweet crude, because it, the NAFTA yield and all seem to sort of work favorably with them. So we think TD22, which is your US Gulf to Far East VLCC rate route, has been doing really well. It's off the highs. Those are the panic highs, however, just after the sanctions were announced, but still at a healthy 7.4, 7.5 million lump sum, putting about $40,000 into a ship owner's pocket. So that's a very healthy return.
And June, on your side, what are you seeing? The impact on the sanctions, or the impact of freight on trade flows.
When the OFAC sanctions first blew up, indeed the MEG grades really shot up, both in the Brent. You can see the Brent Dubai being very narrow, and the Dubai grades really was strongly priced. Murban, the Omans, and that kind of incentivized a lot of WTI flow, particularly CPC coming into the east. But as we hit to the March trading window for May loaders, we are now seeing the premiums come off significantly. So although the EFS is trending lower, the Brent Dubai spread is trending lower, but the crude premium for the eastern grades have now come off so much, to like almost $2 per barrel lower from the February numbers, that WTI is actually now landing close to parity with Murban. And effectively, the ups is shut, even though it suggests we should be taking that excess oil, like sweet oil.
Right.
Yeah.
And would you have a hypothesis? Sorry if I can ask a question.
Yeah.
You can.
Because they edit this stuff out. Yeah, I'm sure.
Yeah.
What do you think is driving that? Why has sort of Murban come to parity? Because Murban was probably underlinked to Dubai as well, right?
Okay, Murban is normally the base crude slate for the east.
Correct. Yes.
And we don't really need the injection of extra oil coming from other regions to fill the base demand.
And so what's changed? The question is, what's changed between when the arbs are open? And I ask especially because even yesterday, rather on Friday, again the WTI and Dubai difference has suddenly widened up again. Yeah. So how reliable, the question I always ask is, how reliable is a week on week change in paper arms? How reliable indicator is it for freight? Yeah. That's obviously, I approach it from that standpoint. Yes, traders could lock in a paper profit, right? But how reliable is an indicator of whether my market will move on that or not, right?
Yeah. I mean, I can answer a part of it. Look, what we've seen on the evidence that we've seen is it's a function of, I would say, for the amount of margin, so the incentive. At the end of the day, it's all about the incentive.
Yeah.
If the incentive is big enough, then you have more people looking at it. Then it's the timing element, because one thing is the paper, and some people will lock in the paper and then try to convert that paper strategy into a physical strategy. Or some people will say, I want to lock in the physical directly, which takes longer than the paper. So it's a question of how big the margin is and how long that ARB is open. And then, in order for you to get a scientific answer on that, then you need to start actually look at the data and look at historically if there's any patterns or things like that. But I would say, I don't know that much on the impact on freight. I know more around the impact on the ARBs, on things like spreads or cracks. But generally speaking, you would need something to be open at least 2 days, 3 days to actually have a meaningful impact. It used to be a week. Now it's basically 2 or 3 days because you have also higher liquidity on the ARBs and on the spreads. So generally, that's the window that you would need. And so, but what we're seeing right now is that historically you would have an ARB that is open maybe a week or 2 weeks. Now it's more like an on and off kind of thing. And for actually that to have an impact, it would be 2 or 3 days open, 2 or 3 days closed, etc.
Yeah. So going back to your point, then if it's been closed for 2 weeks, if the Murban have been closed for 2 weeks, then by design, I would have expected deferred VLCC contracts, freight contracts to come off, because that shuts off a long haul trade. But so far, I'm not seeing that.
Okay.
Yeah. So far, I'm not seeing that. I'm not seeing deferred contracts come. As a matter of fact, they continue to firm, and so does the spot.
Yeah.
So I guess the story becomes, how much do I take away from what's happening on the freight side versus how much do I take away from what's happening on
the other element is as well quality. It's not because the ARB, it's the ARB from the WTI may be open to the Far East on paper, but ultimately what people are looking for is mostly these heavy crudes or sour crudes.
Yeah.
Because you have a better margin.
Correct.
Or and it's not, for example, we saw a lot WTI being open into Far East this year, and that's more or less what you're saying, that you would have expected the more flows, or at least that differential between Afra and VLCC to be more evident right now. But then refineries need to adjust to that, so it hasn't really been a thing, buying WTI. No, correct me if I'm wrong, I'm not a specialist in crude, but it's quite rare to see WTI going into these directions, right?
Not to say rare, but as always, well, the prices is about marginal players.
Yeah.
So the marginal players, the Southeast Asian buyers, those were rare buyers, and we have seen a lot more flow for them when the ARB was open. The Koreans will obviously continue to buy. That's confirmed.
Yeah. But systematically, about a 2 million barrel per day shift is what we have seen after the OFAC sanctions kicked in. So when it's a difference, that's 2 million barrels per day of less Atlantic basin crude, which is going into Europe, and 2 million barrels per day more coming into Asia Pac. That's a VLCC a day. So that's the scale of change that we have seen. Yeah. And obviously, and sort of freight, I think freight tells no lies. I like that. So the only reason why VLCCs have gone from earning $19,000 a day to $45,000 a day is because there's a sustained and a large change in the flow of Atlantic basin crudes, which is being triggered by the Dubai WTI and Dubai ARB. This is not as scientific or as accurate. It's scientific. It's not as accurate a computation as what comes from a Sparta platform, but it's correlating really well with VLCC rates. When I say it, I mean the spread between WTI
Yeah.
and Dubai is really correlating very well with VLCC freight.
I think maybe just a watch point, right? Northwest Europe refineries will also happen to be having turnaround period.
Fair point. Yeah.
The WTI that used to go there will now start to go back there again as well in this current buy window. So I think it gels with the current picture that we're seeing, which is WTI is going to flow less to Asia for this trade window onwards.
Yeah, no, it's a matter of I would say the main driver was obviously, as you mentioned, the fact that you had all of these removal of all of these vessels, and therefore it had to be replaced with VLCCs. What we saw is that that the Aframaxes coming from the WTI or the US to a certain extent did have an impact, but not so much right now. Is that more or less what we're seeing?
Potentially also maybe there's an element of just more supply available in the West of crude, right? There was, even before this year started, there was all this talk of incremental supply growth in the non-OPEC supply growth. Yeah, and to that extent, CPC is bringing on almost 250,000-300,000 barrels per day more crude as the Kazakhstan oversupply story continues. The US itself has a larger exportable surplus, partly because of refinery maintenance in the Atlantic Basin, but also partly because offshore Gulf of Mexico crude production is at a record high.
But at the same time, US crude stocks inventory are low.
Yeah, it's coming down.
Yeah,
it's coming down. Yes.
So, what is your view now? If you take a picture of what we're seeing right now, in terms of more on the oil side,
okay, on the oil side for at least WTI, crude stocks are low there in the US. So we are expecting WTI to be supportive versus Brent. So TI Brent spread as it is should continue to strengthen because WTI is going to be supported.
Narrows.
Yeah.
So TI Brent should start to narrow up. Yeah.
Yes. We need to basically see WTI linked crude remain or stay priced within the US to incentivize stocks to recover in the US. And it doesn't help that Venezuelan sanctions are coming, so shortage of about 250 kbd of sour crude, and all the Canadian and Mexican tariffs will hit the heavy crudes first, and they will need to continue to, at the margin, keep WTI linked crude, Mars, WTI itself, Thunder Horse, to stay in the US.
Yeah. Well, this is a good segue into tariffs. So tariffs, they're on, they're off, they're but let's just imagine they're on. For the sake of argument, what is the immediate impact on the freight market specifically?
Assuming the tariffs on Mexico and Canada are on.
Yes. Let's start with those ones. Yeah. Because we could do a show only about tariffs. Yeah, but
so if it's a 25% tariff on Mexican energy, it does tend to push a lot of Mexican crude out of the US market. Right. So we think what it does is it calls into question how much replacement crude becomes available, and to some extent, there should be some surplus available if the Middle Eastern crude can get redirected. Yeah, and with China going into some maintenance, I think there was some news flow last week that Saudis are selling much less term barrels into China through April, so that crude could potentially be sailed into the US market. So it becomes positive for dirty freight because it pulls in long haul barrels. It's certainly positive for clean freight because partly it's the US Atlantic coast. Before I go to the clean side, on the dirty side, also got to think about the TMX barrels. Where do the TMX barrels go? Because the 10% tariff on them as well. What happens to the Canadian East Coast Hibernia barrels, which are fairly light sweet, very mobile cargoes? So on the TMX side, we think that at a 10% tariff, it costs roughly about $8-9 to swing a barrel away from currently the default barrel goes to the Gulf Coast, right? So if you want to swing it into Vancouver, it's about $8-9 a barrel, so which is roughly equal to the freight that you would need to pay. It doesn't really make sense to swing a TMX barrel. But it does make sense to take the Hibernia barrel, the East Coast Canada barrel, away from the USAC.
Okay.
Right. So that also we think adds to freight strength for Aframaxes and to some extent the broader mid-size component.
So you think that because obviously the first question people are asking themselves is, can the U.S. Substitute all these? If we're combining Mexico plus Canada plus Venezuela, where are they going to replace these heavy barrels? And so the conclusion that we got to, and I think you have the same conclusion, is Middle Eastern barrels. Like back in the day where Saudi was exporting tremendous amount of volumes into the U.S. The other alternative is that the U.S. just pays up, and that is passed along to the consumer. What do you think is going to happen there?
I think as a refining center, we look at the U.S. Gulf as the last man standing.
Mm-hmm.
They have the most complex refining system, the most profitable one, right? So they could pay up another $2 or $3 a barrel in freight cost and still remain more profitable than European refineries in general, right? So
Yes.
they're the most
No, fully
complex
agree.
barrels, right?
Fully agree.
So I think they would pull in the marginal barrel away from other refining centers. So in our view, that if it does create a deficit, it creates a deficit in the more handicapped regions, refining centers of the world. So we think the Med refining system becomes potentially deficient, and therefore there we could see some shortage of crude because the U.S. Gulf has the ability to pull in, which then becomes sort of leads into how the clean sector respond, because then the clean segment says, well, there's a deficit of refined product in the Med, so we've got to push barrels into the Med. And to us, we then say, well, then we put the freight hat on and we say, okay, now that's positive freight.
Yeah.
And so that's positive LR2 freight and LR1 freight. So that's how we think. But even just outside of the crude flows rebalancing, the USAC, which is the primary target for Canadian gasoline, small flow, but yeah,
regular.
it's
a
sizable, right? On a 700 kbd import basket, it's about 100 kbd.
Mm-hmm.
So it's 12-13%. So that, how does that deficit get filled? We think it's probably more European barrels which would have to come into that space.
Yeah, I will talk about it, but we see already that these ARBs, particularly when compared to the last 2-3 years, where the summer ARBs of gasoline into the U.S. were closed for pretty
Yes.
much the majority of summer. Actually, this year we're seeing that that's not the case. Now we're back to the gasoline that I knew when I was trading, which was every summer you had this steady flow of gasoline going from Europe to the U.S., and we're starting to see that again. But mainly I would say as a consequence of different topics, but one of them being the potential of sanctions or of these Canadian barrels. Yeah.
Right.
But on a longer term perspective, what do you think is going to be the impact for freight? Is it going to be bullish, bearish, and
Yeah, tariffs longer term, they are sort of bearish for economic growth, right? And it does seem like the president of the United States is sort of playing it as a base case that there will be a recession in the U.S. Don't know how deep, how shallow, how long for, but if the U.S. goes into even a short-term recession, it's bearish for Europe, and then cascades into a wider malaise. And so we don't think it's going to do much for freight markets. As a matter of fact, you're looking at some numbers the other day, and what we tried to do was say, well, before the 2018 tariffs were brought in, what was projected trend growth for global GDP, and what was achieved? And there was 1 percentage point shortfall between what was being projected at the end of 2017 through early 2018, and how 2018 and 2019 actually panned out. And so global growth certainly slowed down below projection, below trend. And freight suffered. 2019 was a really poor year for VLCC markets.
Well, for much oil in general as well.
Yeah, true.
No, but and it makes sense, and And actually, this time around, he's even going stronger with his messages and with his intentions. And the thing is that on a business perspective, having those sanctions in place or not, in a way, almost is the same thing, because now everyone else is sort of reorganizing themselves as if they could happen. So the trade flows continue, but there's let's say you're not thinking about expansion, you're not thinking about so you become more defensive, and that also affects, even if it doesn't happen, even if the sanctions were just a threat, it affects trade flows indirectly.
Yeah. It does handicap growth.
Yeah.
Which is, if you're adding ships into the fleet, then you need trade growth. Otherwise,
Correct.
rates suffer, right?
And we'll talk about the supply and demand on ships in a second. Now, just before we wrap up, on your point of view for the oil side, what do you think? We've talked extensively about this on our podcast. Can you summarize roughly, quickly here, the impact of tariffs on the short and medium term?
We are quite aligned with your view, Anoop, where there will be a rebalancing of the flows. U.S. Gulf Coast will need to pull from LATAM grades, excluding Venezuela. They will be able to pull even as far as North Sea grades like Johan Sverdrup for replacement. And of course, the marginal barrel is like Arab heavy and maybe the Iraqi barrels. So I think the only thing that we never really cover is what happens if Russian barrels come back. We also talked about that in the previous podcast. The Urals and Russian fuel oil, which is M100, is a very good. It can blend very well with WTI to make a proxy look-alike Canadian crude replacement. So if that comes in, then US Gulf Coast will be very well supplied again.
Yeah.
The last element in terms of all of the geopolitics is the other potential threat, or for the US, is China. And there's been talk about a USTR proposal for additional fees into Chinese shipping companies. Now, what's your point of view around that? What do you think will happen, and the impact, of course?
Yeah, it's already, again, like we spoke about tariffs, and whether they come in or not, they start to hurt flows and economic outlook. It's like that. Whether the USTR eventually comes about or not, it's already starting to shake the freight markets. So there are some
what's the cost that they are proposing for this USTR?
It could range from anywhere from $500,000 to $1.5 million. Depending on whether or not you're a Chinese built vessel, or whether you've got what percentage of your fleet is built in China. So even if the ship that's going into the US port is not a Chinese built ship, but you are operating a 25% fleet, which is 25% Chinese built, then you're again, you're looking at $500,000 of,
regardless of vessel size.
Regardless of vessel size. Yeah. It's per port call basis. So it's they're drawing on a very, very large canvas here, but it's already started to shake up freight markets. People who are now much less willing to take a Chinese built ship on long-term time charter. Deals have failed, actually failed, and so it creates the uncertainty. That's the first step, right? It creates the uncertainty, and maybe that's the end objective. Yeah, maybe it's just a sort of a warning shot, and we might see nothing come through at the end of it. But as analysts, our job is to try to, take it to perhaps it's one possible scenario in which if let's say it does come about, and it comes about in the way, shape, or form that is currently being painted, then we think it's a very bullish shock for freight markets. It's bullish shock. First is from the point of view of where else can you build ships if you can't build them in China?
Cost of production.
Yeah. There are not many places. Globally, shipbuilding is now becoming very concentrated in China, especially for the sort of commodity shipping. Just as statistics, almost 71% of the tanker order book currently, which are to deliver over the next 3 years, that's being built in China. So that gives
Okay.
you the scale, right? So
Okay.
if you're building 3/4 of your ships in China, and that goes away, then and the tanker fleet is very, very old.
Yeah.
The average age of the tanker fleet is the oldest it has been since 2001.
Yeah.
Yeah. So you need a lot of replacement vessels, and you can't get them if Chinese ships get sanctioned out or tariffed out or whatever, right?
Okay.
Or costed out of the business. So it is that bullish shock. People will become slower in ordering replacement vessels. They will look for other places where they cannot build.
And you said, yeah, so the alternatives would be typically Korea, historically, Japan. Yeah, Europe has no, I don't know when was the last time Europe built a vessel, but
Yeah, not commercial ships. Building ferries and cruise ships, but not really building commodity
Exactly.
ships.
But I mean,
To some
70%
extent,
is huge.
Southeast Asia, Vietnam does build a few, Philippines does, Romania does.
Okay.
But yeah, I mean, we do anticipate that they're going to be on the margins. There are ship repair yards in Turkey,
Mhm.
which could be
Repurposed.
repurposed. Romania, they could be repurposed.
But that takes time.
It takes time, and capacity is a constraint.
Mhm.
But even on the short term, right, there will be a deficit of vessels. Number one, yeah. So let's take the simplest case where only Chinese built ships are being tariffed, right, or being asked to do port calls, additional port costs. The US needs about 105 VLCCs to run its current trade volume. Yeah. And it'll have access to only 75 ships. Right? So there's a 30 ship deficit. Then some people argue that you could create a two-tiered market where you completely remove ships which are built in China from the US market.
Yeah.
But if you're using a fleet which has Chinese built ships, you're still being levied a cost. Yeah. So we don't think it's going to be very simple to create two different fleets, one for US trade, one for non-US trade.
Yeah.
And then the third part is that if you are trading, for example, a Suezmax or an Aframax, these are by and large trading in the Atlantic basin, so trading across both coasts of the Atlantic basin, Europe and the US. So if you're now dedicating a ship only to the US trade, that means it will not triangulate, it will not optimize, right? It will be ideally suited to just the US trade. So goes one way out and then comes straight back down, right? So it's reducing its productivity.
Yeah.
So we have there's a deadweight loss, productivity loss that will come through as well. So that's why we think it's a bullish outcome.
Well, yeah,
if it were to happen.
Because ultimately, if that is the case, for example, you're not optimizing a vessel. Essentially, it's driving the cost up, which then sort of equates to the tariff or to the extra cost. Sorry, not tariff. I get confused with tariff. But with the extra costs, and eventually you end up in a situation where that two-tiered market just becomes one, but just more expensive.
Yeah.
For everyone because of this lack of efficiencies, etc.
Yeah.
No?
Yeah.
So okay. And June, on your side, what are the Sparta thoughts, if you want, with regards to this?
From Michael Ryan, we were going towards the two-tier market, where the US will be served by non-Chinese fleets.
At least at the beginning, naturally, yeah.
Yeah, and again, all cost of products goes up, bad for economy, overall shipping cost goes up, and then we have the East that will enjoy a bit of that benefit. But as you mentioned, it might not be a realistic long-term solution for the trade market.
Unlikely to be a long-term solution.
Yeah. But ultimately, let's not forget. I mean, that is the message that whether it's Trump or the Secretary of Treasury are mentioning, is it's a short-term pain for a long-term gain. And now I don't know if that rhetoric will last. If we do go into a recession, they're sort of warning everyone, hey, we need to do this for the long term, and therefore, if there is a recession, so be it. They're sending that message across, and ultimately, here the idea is, China is a challenger. I wouldn't say an enemy necessarily, but a challenger to the U.S. economic supremacy. Therefore, we need to take these measures, and we cannot rule them out. I mean, it sounds, it sounds completely inconceivable at this stage, but it's definitely a potential. So having this scenario playing, and whether it's the two-tiered market or not, is something that people need to understand, particularly if, as you said, 70% of the new builds are now done in China. It's a huge impact.
And that's just tanker ships. It's
Yeah.
the same for container ships.
Yeah.
Yeah. So,
Exactly.
Yeah, and that could be an even bigger sort of inflationary stroke, cost raising implication.
Yeah. So this is a perfect segue into the freight supply and demand. You mentioned just now that the fleet is quite old, and we've
Yeah.
been, what is it, since 2001 we haven't had such an old fleet. Is that correct?
That's correct.
So tell us about more. Can you elaborate on that? Where we are? What are the trends that should be happening? Let's start maybe with LRs and Suez Maxes.
So the fleet is very old for sure, and to some extent it's still finding occupation because the Russian trades are absorbing a lot of that tonnage.
Yeah.
The Iranian trades also are absorbing a lot of tonnage, which would otherwise have not been found, would not have been able to so easily traded as it is now.
Yeah.
Right now, and we've lived through almost 3 years now of very, very low supply growth on the shipping side. But that's starting to change. So there's almost 65 Afra LR2s. We tend to now put them in the same basket now because there's a lot of fungibility between Afra Max and an LR2. So there's 65 of them getting delivered this year. And after almost 2.5 years of almost no supply, we're also getting 39 Suez Maxes delivering this year. So the supply growth, at least on the mid-sized tankers and on the MRs, is starting to manifest itself again.
And just for my knowledge, because I'm not aware of the supply and demand, 65, how much is that relative to the existing pool?
Okay, good question. There's about 1,000 Afra LR2s combined.
Okay. And so 65 is relatively, relative to other years, is that a high number?
It's a very high number.
It's a very high
It's
number.
a very high number, yeah. So for give example, we had only 17, 18 delivered last year. Before that, even a smaller number. So for almost 3 years, there were hardly any ships being delivered. At the same time, the entire trade flows had shifted because of the Russian invasion of Ukraine.
And then Suez as well, delaying
Correct.
even more. Correct.
Yeah. So all of that, all the demand impulses had come in without any increase in tanker supply. So tanker supply is now starting to rise, and if nothing else changes on the Russia side, even just the fact that you've got more ships coming in, that should start to soften tanker markets.
Yeah.
Now, there's a little bit of a balancer in this because, as I mentioned, the tanker fleet is very old, right? And if there is no negative demand shock for tanker markets, then the fleet, which is going to get into this untradable age segment, by and large mechanically balances the incoming deliveries.
Yeah.
Right. So yes, I mean it prevents freight spikes and to some extent softens freight as well. But it's not cataclysmically bad for tanker markets, even with the order book of 2025 and 2026. The negative shock which could come through is if there is a resolution in Russia-Ukraine.
Yeah.
Because that then vacates demand for roughly 150 Aframaxes and about 45, 50 Suez Maxes. So you don't have demand for these many ships.
Correct.
Even if in the scenario where trade flows completely reorient backwards, then that's a massive negative demand shock for tanker markets. And then on top of that, if you add X number of new buildings this year, a large number of new buildings next year as well, then we're looking at a sustained 2-3 year of very, very low freight rates, because you need to have very low freight rates to encourage ships to scrap, to encourage owners to scrap.
Correct. Yeah. In an environment where you do have a lot of vessels that are in the list of in the scraping list, if scrapping list, the velocity of price going down will determine how fast we scrape them, essentially. But it does put a ceiling there to any kind of price cap, or a price cap, if you want to freight, and a certain pressure for a sustained amount of time. Yeah, I fully
Yes,
understand that.
yes,
Yeah,
yes.
makes sense.
And just to give you a sense, the last time we were able to scrap 100 ships from the Aframax pool was in 2017-18, and that time the index had to come down to almost $10,000 a day.
Correct. Yeah, yeah.
So
And for a
that's,
long period of time.
2 years, two and a half
Exactly,
years.
Yeah, yeah. The market was quite depressed at the time.
Yeah.
I remember. Yeah.
Yeah.
Which created many opportunities for new entrants in the market, particularly traders as well. Remember when I was at Gunvor, we were looking at not necessarily these size vessels, but more MRs and things like that. But the whole industry was quite depressed, and it creates new incentives. Yeah. I've been told there's a potential VLCC boom. Is that what you're seeing as well, or how would you describe the potential for VLCC?
So we think in a business as usual scenario, the VLCCs will do well so long as the ARBs to ship more Western crude to Atlantic Basin does well. The structural bull for VLCCs was and will remain China, and that structural bull is now very, very weak.
Yeah.
So we are not in the camp which says that there is in a business as usual environment that there is a bull cycle for VLCCs. We think it's a healthy cycle, because even outside of what's currently driving the VL market, the projection is for non-OPEC supply to grow rapidly this year and reasonably well next year as well. The bull case for VLCC, we think, comes if if Trump goes hard on Iran, because that Iranian trade currently occupies about 120 VLCCs, out of which at least 70-80 are untradable outside the Iranian business.
Yep.
So in the environment, in a scenario where Trump is, let's say, the U.S. administration is able to remove, let's say, half of Iranian exports, then the replacement of that from wherever it comes from, even if it's from the Middle East, will have to look for tankers which are not in the Iranian trade, because there was a sanctioned away. They're very old. Nobody else touches them from a loading standpoint. Saudi Arabia or Kuwait or whoever else, right, will not berth a tanker which is 26, 27 years of age. Right. So that transfers demand to the younger VLCCs, which are we call them the primary pool, and the primary pool. Then that's a bull case. Yeah. So it is. So that's a positive for VLCCs, but it's a scenario based thing. Right. We also have started to think about VLCCs as anti-fragile. The next set of geopolitical dominoes which fall are going to be bearish for Afras and Suezmaxes, specifically from resolution on Suez, resolution on Iran, on Ukraine and Russia. So there, the segments which had benefited the most are going to see the greatest amount of demand losses. But all of that is going to transfer demand to the VLCCs.
Yeah.
The Russian war took away demand from VLCCs, parked it into the mid-sized tankers. As that unwinds, demand comes back to the VLCCs, and it weakens the mid-sized tankers. So we think of it as a bit of an anti-fragile, with upsides, but a lot of it is dependent on how far action can be taken and be successful against Iran.
Yeah, and you mentioned the word, the expression "business as usual," which these geopolitical decision makings are business as usual, I guess, for the people who are building ships, or but man, what a difficult decision to make when you don't really have any idea what will eventually happen. But it is your business as usual to make decisions in this environment. But I see what you mean with the sort of your hedge, VLCC being your hedge. That is the one that, in an environment where everything is so unstable and unpredictable, VLCC is the one that gives you the most amount of certainty. Is that correct?
Yes, I think that relatively the more insured vessel class,
Correct.
in our view.
Yeah. And how about the scrapping rates? What do you think will be the next trend?
Scrapping has been very low, obviously because freight rates have been high.
Yeah.
Yeah. Uh, uh, so most of the old tankers have just gone out of the shadow fleet, so they haven't really gone to the scrap yards. Obviously, we that will change if there's a negative demand shock coming through from Russia. Yeah, and in which case then scrapping will tend to pick up. The question marks that are being placed is, if you're a sanctioned vessel, that means you're OFAC sanctioned, which are sort of binding in nature. That means even if the vessel is sold, the sanctions tag carries it on.
Yeah.
Carries with it, right, with the life of the ship. So will a buyer pay US dollars to buy that asset, even if it is meant to scrap?
Yeah.
Yeah.
Okay.
Yeah. So how does that happen, right?
Yeah. It's a good question. Yeah, because even if it's no longer in service and you cannot use it for, sanctioned business, can you scrap it? Yeah.
How do you scrap it? Yeah.
Okay, I never thought about that.
So that's a question mark. That's a question which we are wrestling with. Yeah, I mean, I don't want to speculate on whether that will mean ships being scuttled at sea or left with the keys on and without people driving it. But yeah, it's a question which will need some thought and some.
Where does the scrapping normally take place? In which countries? What are the main ones?
India, Pakistan, Bangladesh are the three big.
Yeah. So in that
destinations
case,
for
India, I mean,
scrapping.
generally, Indians have a privileged position, if you want, in the geopolitics right now, where they're everyone's friend, and they're being allowed to be everyone's friend. So in that case, maybe, and we've seen that with the sanctions, where it continued going to India and China, essentially, and India was the biggest benefiter of all of this. So maybe they benefit as well on scrapping as well.
I wouldn't disagree with you on that. I think that's certainly possible.
Yeah, let's see. The third topic is there's a lot of changes when it comes to refining, and we've talked about the Gulf Coast being the last man standing, but and the Med actually suffering quite a lot and potentially losing its economic value, and therefore we're seeing already some changes. Dangote being one, Dos Bocas, but also some refineries shutting down. That obviously will have a dramatic impact on flows and freight rates and demand for vessels, etc. Let's start with Dangote, if that's okay with you. If I understand correctly, they've been buying crude, WTI, and other sweet crudes as well. Is that correct?
They just bought Equatorial Guinea crude as well last week.
Okay, so they've been importing crude. So that's the first sort of trend. But also the other trend that obviously will have a big impact is how they export, because it's not just the freight from that area, but also how it affects gasoline, diesel, and there are different kinds of imports. Now, what is your point of view of assuming Dangote is fully up and running? What do you think is going to happen on both the crude side and on the product side?
I think the big impact is mostly on the products, because West Africa and Nigeria specifically was a big clean trade route, European gasoline and Asian diesel finding its way into West Africa.
Yeah.
So this is, in our view, basically an import replacer refinery as designed. In practice, I don't know how it'll pan out, right? Because of all the challenges with the refineries facing in terms of finding the right balance between domestic crude and international crude, being able to sell its product in a local currency and being able to get the right value in international terms, because it's still exposed to the international markets for its crude prices. Going forward, if crude remains soft, what is the incentive for an NPC to supply crude into Dangote in Naira, whereas it could export, and those decisions are going to become much more critical at a lower crude price, right? So it's a big question mark whether or not it's up and running, but assume it is up and running, then it's bearish for clean tanker demand. our estimate is a net negative impact of about 80 MRs worth of demand.
Mm-hmm.
Uh,
80, yeah.
80, out of which about 50 has been manifested already, right? So because we've lost flow.
Yeah, we've seen that
We've,
already.
we've, we've seen we've seen gasoline flow, even diesel flow into West Africa come off. But yeah, if it carries on progressing, then it's bearish. In a scenario that it does ramp up to peak output, and everything else which is in the pipeline, the Port Harcourt refinery is also being targeted for mechanical restart and increase in runs. In a Goldilocks world, ideal world, then we think the region could become an exporter of product.
Yeah.
And then that could start to compensate a little bit for the refinery closures that we expected to see in Europe, already announced and then anticipated in the future as well.
Yeah. So before we move on there's an element as well of quality, and we've had this discussion multiple times in different episodes. Is slowly, Dangote is producing higher quality grades, and that gap or that spread between the quality they produce and the local quality is becoming so significant that there is a potential um, for them to export their products and benefiting from a higher price and import low quality material at a significant spread. So that's one thing that right now we're not seeing yet, but could potentially happen. And the other element is, as you mentioned, is the Naira element, because here you have, as a country, you have the potential to be exporting quite a lot gaining a lot of dollars through the exports of crude, etc. So how are you going to manage that? And can one company manage that exposure? No, that's
to be able to do that, to be able to buy in lower spec and export higher quality product, we would also have to see two-way freight being covered by the quality differential.
Yes.
Inbound freight and outbound freight. I had done the numbers on this mid 2024, and I don't have the full details off top of my head, but at that time, to us, it didn't make sense to the two-way freight wasn't enough to cover the quality differential on gasoline.
Yeah.
So
on gasoline, I would say, it can easily be, I don't know, $40 a ton. Huh?
That's the number that we had used.
Yeah.
$40 a ton, and just TC16 freight that time, one-way freight was at $30 a ton.
Yes.
Now it's softened a bit, right? So if it happens, it may happen periodically, sporadically. It may not be a system trade. Yeah.
Yes. Yeah. But in any case, indeed, it will accelerate. It will accelerate these. The impact on European refining and shutting down.
Yes.
In a way, I think that everyone sees this as an inevitable trend. The question is when, not so much if, but actually is when. And what have we heard in Europe? We've heard Grangemouth,
Wesseling.
Yeah, Wesseling, all the the small
Corinth.
inland. The bigger impact will be when you will start seeing more of the big med refineries, shutting down, which is nothing has been announced. If I'm okay, but it seems like the inevitable sort of trend, particularly as we see other Middle Eastern refineries coming up as well. Am I missing something? Am I forgetting something here on that we want to talk about with regards to these trends?
No, I think a lot of talk about closures, but in reality, the quantity that we are seeing is actually dwarfed by the amount of new builds and the like Yulong coming up, another 400 KBD is coming out end of the year. So in the scale of things, the closures really don't mean too much in terms of change of trade flow. Yeah.
Now, we've covered Dangote. That's obviously the big change, and then we have new refineries coming up, like Yulong, which is 400,000 barrels. Dos Bocas, 340 eventually. Then there's another one coming in second half 25 in east of Suez of 400,000 barrels. And on the other side, we have refineries shutting down. We talked about Lyondell, we talked about Grangemouth, Wesseling, Dalian as well. What is this telling us? This is, it's been a trend ongoing. But what is going to be the impact on freight particularly and on cargo, later on?
So on freight, we tend to think of China as a bit of an island, because the export volumes are very policy driven, and we don't see a policy change coming through in China. So yes, Yulong will start, Dalian will close down, and domestically refineries will balance off without creating a massive change in the volume of clean product coming out of it. So we tend to think of that a little bit in isolation. On Europe side and in the US side, we do think it creates a bit of a deficit for middle distillates,
Yeah.
and for gasoline both. And so in our base case, we think Europe will demand about 250 kbd more middle distillates this year than it got last year. And this is a bit of a mechanical estimate. We take about 100 kbd each coming through from Dangote and Dos Bocas this year, so not full ramp up.
Mhm.
And we assume 385 kbd of refinery closures in Europe when you sum up all of that,
Yeah.
and 215 Leondel Basel, right? So that's net, it still leaves Europe deficient by 250 kbd of middle distillates.
Okay.
So we think, where does that come from? Towards the end of last year, we saw a lot of TA flows of middle distillate because the US was ramping up runs.
Mhm.
This year, we think that story is done. If anything, lesser product from Russia because of all the action on its refining capacity is going to make US product more desired in Latin Americas. And that means European short is going to be met much more by Eastern Suez barrels, which we think is one of the big positives for clean tanker demand
Mhm.
this year.
And on the cargo side, you see the same thing?
Yeah,
Or-
we are seeing similar trends, but I guess overall we were looking at the big picture, which is the world is likely still having enough refinery new builds to cover for the deficits and the closures that are upcoming.
Mhm.
So overall trade flow should be business as usual in a way.
And I'm just thinking about this, coming back to Dangote, but if those refineries that were producing high sulfur material, and Nigeria was probably the only outlet left, what's going to happen to those? Because the cost of desulfurization is probably too expensive in an old refinery. Is that going to accelerate even more the shutdown of these refineries? Are we seeing that? Is that being discussed, or?
I haven't actually heard anyone commenting or saying that the cost of the desulfurization in old builds is much higher than new
Okay.
builds. In fact, in the typical refinery configuration, the hydro desulfurization unit is not very, very expensive unit. It's
Okay.
more like the hydrocrackers, if they are closing down or if there's a new build coming out of hydrocracker particularly, those will be the one that is like having a significant cost delta between new and old setup.
So if I understand correctly, what you're saying is that even if, let's say, as you were mentioning, Dangote takes care of all of the supply locally, and there's, we've seen it less and less imports of gasoline and diesel, it is a solvable problem as a refiner in Europe. They will be able to desulfurize and therefore sell higher quality grade somewhere else.
I
Is
would
that-
expect so, yes.
Okay, it's not an impossible problem to solve.
Yep.
Well, look, I think we've covered everything. This has been very exciting. Thank you so much, Anoop. It has been a pleasure to talk to you. I'm learned a lot about the shipping industry. Some key takeaways for me again is this USTRs again and China. That's something that I did not have in my radar. We keep talking about sanctions, tariffs, and things like that, but obviously it is something that we need to have in the back of our minds, especially if 70% is produced in China. But yeah, very exciting times ahead. A lot of it, some of it quite bearish as well. So I don't know if exciting is the term, but definitely very uncertain. I think the word is more uncertain than exciting. But thanks so much for your time. It's been a pleasure.
It's been great to speak to you, Philippe, and to June. Thank you.
Thank you very much.
Thank you.
June, thank you very much for your time today as well.
All right, thank you very much.
Thank you.